All right, let's talk about how you actually go about adjusting accounts. Here in your book, it explains that adjusting accounts is a three-step process. You determine what the account balance currently is, you determine what it should be, and then you record the adjusting entry to get 1 to equal 2. Let's talk more about that. Basically, adjustments are necessary for transactions that extend over more than one period. Okay, so we're talking about when you have two different financial accounting periods and the expense or revenue extends over those two periods. So you have to adjust it to put the right amount in each period. If you look here at this chart, there's two basic types of adjustments. So first of all, there's the type that has to do with you either paid cash or received cash before the expense or revenue is recognized. So the money is either gone out or come in, but it's not in the right period. It should be in the next period. And then over here, you're paying or receiving the cash after the event should be recognized. And so in the current period, you need to make an adjustment because you're not going to pay it until the next period. I know that may not make total sense yet, but we'll walk through each of these types of examples. So on this side, in terms of the cash that's received or paid before the event is recognized, you have two different types of things. One is if it's an expense, then that's considered a prepaid expense or a deferred expense. Or you have unearned revenue, meaning you've received the money but you haven't actually performed the services yet. And then obviously on the other side, if it's afterwards, we call those accrued expenses, meaning the expense has been incurred but you haven't paid it yet. In this case, accrued revenues are revenue that you've earned. You've done the work, you've earned the revenue, but you haven't been paid yet. Okay, so those are the two different types of adjustments that will have to be made at the end of each period. And generally speaking, these become just routine. You do them at the end of each period, and there's certain ones like prepaid expense, prepaid rent, prepaid insurance, that are just ones that you do all the time. And even though they may seem confusing now, it'll become just a rote activity that you do at the end of each period. All right, so let's start with prepaid expenses. Again, these refer to items paid for in advance of receiving their benefits. Meaning, again, let's use rent as an example. Often in businesses, you will pay for a whole year in advance with rent. That gives you sometimes a better deal on the rent. But you don't want the whole expense to be recorded in the first month. You want it to be stretched out over the whole year. And so you've paid for it, so it's like an asset. It's something that you have control of, you own, that has value, but you haven't incurred the expense yet. So once that asset is used, meaning after a month goes by, then you have to record that particular expense. So adjusting entries for prepaids increase expenses and decrease assets as shown in the T accounts here. So we'll talk about how to go about doing that. Okay, here's an example. Prepaid insurance. Here's our three-step process. We determined that the current balance of Fast Forward's prepaid insurance is equal to the $2,400 payment for 24 months of insurance benefits. So on December 1st, they paid $2,400 for prepaid insurance. That's going to cover them. That's the premium for 2 years. So at the end of December, they've only used up $200 of the $2,400 that they paid. So what you would do in that situation is, $100, not $200, because it's for 2 years, 24 months. So that's $100 a month. So the adjustment is you have to move $100 of what you've paid to the expense account, and you have to take it out of the prepaid insurance account. So this is the adjustment that would be made. And you see here in your T account, you now have $100 in insurance expense, and you have $100 taken out of the $2,400. So the account balance over here is now $2,300. Over here, you've got a $100 insurance expense. So here's your explanation. You'd have a $100 balance in insurance, $2,300 in prepaid insurance, and this would now be ready to put on your financial statements. If you hadn't made this adjustment, you would be overstating the asset because you would list it at $2,400 when it's really only now worth $2,300, and you would be understating expenses because you wouldn't have the $100 expense over here. Now, generally speaking, adjusting entries are only done at the end of a year. I mean, it can be done on a monthly basis, but often it's just done at the end of the year so that you're not constantly making adjustments. Okay, here's another example, supplies. When you purchase supplies, you're expecting to use those supplies up. So when Fast Forward purchases supplies in December, some of them will be used during the month, but obviously there's still going to be some left over at the end of the year. So what they have to do is do like an inventory of those supplies. Now, what they purchased in December was $9,720. What they find out that they have at the end of the year is only $8,670. That means that they've used up $1,050 worth of supplies. So again, here's your adjustment. How much is the expense? Only what they've used up. So the $1,050 ends up on the left side of the supplies account. Over here, you have to take it out of the supplies asset account. So you're reducing the amount of supplies you have on hand. Again, you can read the explanation here as to how you go about doing that and why you have to do it. All right, at this point, let's assume that these things are going to be done in your balance sheet. This explains an alternative way of doing it, but right now let's just talk about how to go about doing these adjustments, and then they would be posted to your balance sheet account. Okay, there could be other prepaid expenses. We've just talked about supplies and insurance, but as we've already said, there could be prepaid rent as well. You would do those exactly the same way as the two that we just walked through. All right, another example of an adjustment that has to be made at the end of an accounting period is depreciation. There is, you often will have what's referred to as plant assets. It could be equipment, tools, things like that. Here's some other examples: buildings, machines, vehicles. So the issue with those things is that they wear out over time. And the IRS allows us to depreciate those things. So you're allocating the cost of those assets over their expected useful life. So in order to get that depreciation expense in the books for a particular period, you have to do an adjusting entry. So let's look at an example here. Fast Forward purchased equipment for $26,000 in early December, but the cost of that equipment has to be depreciated. So what you first have to figure out is what is the useful life of that particular equipment. In this case, they believe it's going to last them 4 years. But at the end of that 4-year period, it would still be worth $8,000 as salvage. So the net cost of the equipment is $18,000. It cost them $26,000. At the end of the 4-year life, it's going to be worth $8,000. So the difference between those two is $18,000. There's a lot of different methods for doing depreciation, but let's just talk about the simple one right now, which is called straight line. If you've got $18,000 and it's good for 4 years, you just divide $18,000 by 4 years, or in this case 48 months, and that gives you a useful life cost of $375 a month. So each month that equipment is depreciating $375. So the way we would do that particular adjustment is you have an account called depreciation expense, and you put the $375 on the debit side of that. In this case, the credit goes to accumulated depreciation. We don't put it directly into the equipment account. It's just the way that things are done in U.S. accounting principles. we use this separate account over here to record the depreciation, accumulated depreciation. And it's on the credit side because it's detracting, taking away from the value of the equipment. And that's explained down here. This type of account that is reducing the amount of equipment is called a contra account. So accumulated depreciation is kept in a separate contra account. It's called contra because it's going against the equipment. And it's an account linked with another account, in this case equipment and accumulated depreciation equipment. And it's going to have an opposite normal balance, and it's reported as a subtraction from that other account's balance. So here we would have $26,000. Let's look over here at the depreciation for 3 months, December, January, February, $375 a month. The balance of that account at the end of those 3 months is $1,125, which means we would subtract that from the $26,000 in equipment to get our balance at the end of February. So in this case, equipment is now worth $24,875. That's called the book value of the equipment. So the book value is no longer $26,000, it's $26,000 minus the accumulated depreciation. And then eventually this is going to be reported on your balance sheet. And then they show that here as well. So in assets you would have equipment, and the equipment balance would be $24,875. Okay, so those are how you do adjustments for expenses, prepaid expenses. We will move on now to talking about adjustments for unearned revenue. Okay, again, this is where you receive cash, but you haven't provided the products or services yet. So you have to defer the revenue. So when cash is received, an obligation to provide the products or services has been accepted. As you provide those services, those unearned revenues are now earned revenues. So you're having to adjust by increasing revenues and decreasing unearned revenues. So let's look at an example. Okay, this is a newspaper subscription. So obviously you usually pay for your newspaper for a period of time in advance. So when that company receives that money, they're receiving money for newspapers that they haven't delivered yet. So that's unearned revenue. So as you can see here, unearned revenues are nearly 25% of their total current liabilities. Same thing can be true of ticket sales. The Celtics receive cash from advanced ticket sales. They also have to record that in an unearned revenue account. Now the names of these accounts can be different depending on what it is that you're selling. So let's look at this company. Fast forward. It also has unearned revenues. It agreed on December 26 to provide consulting services to a client for a fixed fee of $3,000 for 60 days. So this stretches over 2 accounting periods. So on December 26th, the client pays for the 60-day fee in advance. It covers December 27th to February 24th. So when they pay, it goes into cash as a debit, but then the other amount of it goes into unearned consulting revenue because they haven't actually provided the services yet. But as time passes, Fast Forward earns this payment through providing the services. Now, on December 31st, it's only provided 5 days of service. So out of the 60 days, they've only earned 5 days of it. So in order to calculate how much that is, you take 5 days, divide by 60 days, and that comes out to $250. So at the end of the accounting period on December 31st, you have earned $250 of what was paid you. So you debit unearned consulting revenue because up here you credited it. Because in order to increase a liability, you credit the side. So we credit it here, but as we earn it, we debit that account, but we credit the actual revenue account because now it's been earned. So up here you credit unearned revenue, but here you're going to credit the actual revenue account for what you have now earned. So again, it explains it here. Adjusting entry transfers the $250 from unearned revenue to a revenue account. If you don't make that adjustment, you're going to understate your revenue in December by that $250. You're also going to overstate your unearned revenue by $250. So accounting for unearned revenue is crucial to many companies because many people receive money in advance for things that they haven't provided yet. And one of those examples would be gift cards. So it's very important that we do the adjusting entry for unearned revenue. All right, let's stop there and we'll come back to the other adjusting entries in our next video.